Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. So in today's video, I'll be covering a few different things. I'll be covering two stocks in fact, that I recently just added a substantial amount to. I'll be covering some other stocks that I view attractive in today's market, as well as Copart's earnings report. We'll be doing the first two stocks, and these two companies are actually Visa as well as Mastercard. So Visa and Mastercard are the toll booth companies that provide seamless experiences when someone is shopping online or in person using your credit cards as well as your debit cards. So over here, this is actually a Substack that we posted on our Substack account. It's called Helios Capital Partners. Feel free to check it out. So before we go into why they present decent opportunities today, let's talk about what they do first. So in a transaction, you have four main players: your consumer bank, you have your merchant bank, you have your payment processor, and then finally you have your payment rail. So Visa is the payment network, which is your payment rail. And the difference between your payment processor as well as your payment network is simply the fact that your payment processor has a lot more risk and a lot more competition in the space. So the payment processor is the one that has to carry the risk, because if the consumer wants a chargeback, then the payment processor will need to give the consumer the chargeback, even though they already passed the money on to the merchant's bank. So that's the problem with your payment processor. And besides that, the most important problem with all these different payment processing companies is simply just the competition in the space. So you have many different companies in the space. You have Stripe, PayPal, Fiserv, Global Payment Networks. All these companies, they are all payment processors. There's no one clear winner in the space because it's all dependent on the country geography. So for example, Fiserv is dominant in Europe, I believe. And then you have PayPal that is dominant in the US. And then I'm sure you have other companies that are outside of the US that are dominant as well. But for Visa and Mastercard, these two companies, they are basically global. They have very limited competition. And the only risk that you could possibly see for them is the other companies like Klarna, like Affirm, like DoorDash maybe coming up with buy now, pay later options that will bypass these payment networks, which is Visa and Mastercard. So payment networks, on the other hand, are solely to route transaction data from consumer's bank to merchant bank and to allow money to flow safely and smoothly. In other words, they are toll booths that cannot be displaced in today's world, at least for the most part. So this is how the entire card processing portion works. So next portion is what exactly is the stock selling down and what are the different business models for Visa as well as Mastercard. So Visa has a few different revenue streams under them. They have their service revenue, they have data processing revenue, international transaction, as well as other revenue. So service revenue is derived from transaction fees. Data processing revenue is derived from every single transaction that passes through their network. You have your international transaction, which is your cross-border transfers, or when you go overseas and then you need to use a Visa card. Your other revenue is your value-added services. This is a lot less substantial for Visa as compared to Mastercard. Mastercard is a lot more dependent on your value-added services, which is your consulting-based services, your data services. Visa is more focused on the payment portion, which is why I tend to equal weight them and see them as one single position. So for Visa and Mastercard, most of their revenues are driven by secular tailwinds of the consumer rising over time and the increased usage of Visa's payment rails. So your consumer spending has been growing almost every single year in the US as well as outside of the US as people move from cash to payments using credit and debit cards. And besides that, you have secular tailwinds like your population growth, like increased digitalization, increased industrialization. All this will help Visa over time, which is why your consumer spending has been so strong over the recent years, over the past 10, 20 years. In fact, during the COVID lockdown, during that period of time, Visa's revenue only dropped by around 8%. So other companies out there, your tech companies, they drop earnings by 30, 40%. Visa only saw a revenue dip of around 8%, which is positive. It gives you downside protection also. So Visa and Mastercard are both wonderful business, but of course there are risks to them as well. First one is crypto, which is one that is always talked about now because the Republicans are actively pushing crypto. So crypto is a risk that could come to Visa as well as Mastercard, although I don't see this as substantial risk because it will take time for the adoption to come and I'll have ample time to exit the position if I need to do so. And besides that, Visa and Mastercard, they are also actively pursuing crypto. So they're also creating their own crypto network. And the most important thing and the most important hurdle for crypto is the lack of trust. So over here it says both Visa and Mastercard have countered this by introducing their own crypto network. And then the thing about crypto is the lack of trust. No firm outside of Visa and Mastercard can provide a level of trust that gives the consumer enough confidence to use that payment method. So it's hard for people to use crypto and adopt crypto straight away because crypto is still associated with Bitcoin, is associated with your blockchain, and there's a lot of gray activity happening there, which is increasing the skepticism of your consumer unless your crypto networks, they start giving out rewards and all that incentives to your consumers. But to counter this, Visa and Mastercard, they're already doing this crypto portion and they already have the trust to do so. So it's a no-brainer for a consumer to just use their crypto network if need be. So the other reason why the stock is selling down now is because of your AI trade. So a lot of people now, they're trying to chase all these AI hype companies. They're trying to buy into companies that are moving up substantially in stock price. And retail investors are flocking to your AI investments, while your super investors are actually piling into Visa as well as Mastercard. They're both attractively priced today. And for Visa and Mastercard, the quality compounding machines that the markets are neglecting right now. And there are a few catalysts as well coming up for Visa and Mastercard. So first of all, you have your Trump administration, which is pushing out a lot of stimulus checks. And then the other catalyst, potential catalyst, is your World Cup next year. So next year in the US, there will be a US World Cup. This will drive cross-border transactions in the US, which is the most profitable revenue stream for Visa as well as Mastercard, given the high margin for that business line. And then of course, you have your stock market valuations going up, you have your stock prices going up. People are feeling richer, and when people feel richer, they tend to spend a lot more, which is why Visa and Mastercard, they will see increased earnings over time. In fact, your analysts are projecting around 16% EPS growth for Mastercard, around a 13% for Visa over the next few years. So these are the valuations for the company. Visa is currently trading at a normalized P ratio of around 29 times. And historically, if you were to look at the average over the past few years, this is on the lower side. The last time it traded this low was last year in 2024, around August period when we had the yen carry trade thing. And then before that, it was in 2022 when the stock traded down to around a 25 times earnings. And the average over the past few years has been around a 32 times over the past 10 years. And currently now is trading at 29 times, which is around 10% below that median multiple. So I view these two companies as attractive today. It's almost a 13% guaranteed return. So you have the free cash flow yield, which is almost 100% given back to shareholders through buybacks as well as dividends. And then besides that, you have your net income growth over time, just driven by consumer spending. So consumer spending is increasing at around 8 to 9% every single year. And Visa and Mastercard have consistently increased their take rate over time. So what that will mean is 10 to 13% net income growth for Visa and Mastercard respectively, which means around 13 to 15% EPS growth for these two companies over time, even without multiple expansion. So Mastercard today is currently trading at around a 33 times of earnings. Historically, this is also on the low side. So that's why I've substantially added into these two positions. It currently makes up around 13% of my entire portfolio. And if they continue going down, I'll continually add to these two positions. Next portion, I'll be covering two different companies that I think are attractive today. These are your Max 7 companies. First of all is Amazon, of course. This is an equity research report by DBS. So over here it says Amazon's retail portion is showing recovery. That's one of their theses. And then besides that, you have the AWS portion, and then you have advertising. And they've issued a buy rating for Amazon at around $255 a share. I think Amazon today is currently trading at a 30 times of earnings. Historically, this is on the lower side. That's one thing. And besides that, I think Amazon has many levels to pull. So they have their retail portion, which is increasing margins over time. Currently, it's around 2.5% margin for that portion, which is still very margin dilutive, which is why the retail portion is still not a substantial portion of their entire net income. They have other revenue streams coming in like advertising, like subscriptions. In fact, for next year, for the subscription revenue line, if you were to look at the trend over the past few years, they've increased prices every 4 years. And the last time they increased prices was in 2022. So we can expect a prime increase next year of around 20% in terms of pricing. That will boost up their earnings next year under the subscription portion also. And then you have advertising, which is a high margin business that the company is pushing over time. If you were to look at the growth under the advertising portion as compared to Meta as well as Google, Amazon is currently growing that portion at around 23% CAGR over the past 5 years, which is extremely attractive. It's on par with Meta. But the problem that I have with Amazon is simply the fact that the company's entire narrative is dependent on AWS. And AWS is a portion that is highly unpredictable. It's driven by deals, it's driven by our AI sector, and currently now they still have more than 50% of their net income coming in from the AWS portion. So that's the portion that I'm a bit uncomfortable with, although I still think that the company today is presenting a decent opportunity just from a historical valuation perspective, which is why I think Amazon could be an ad soon. My model puts it at around $215 fair value, which is around today's stock price. So I view Amazon as attractive today. There are many different levels that they can pull under the retail portion, and the margin profile for the company under the retail segment has a lot more room to grow over time. So the other company that I'll be covering is Meta. Meta is a stock that is down around 20% from its recent high before the earnings report. So this was a newsletter that I wrote out before Meta's earnings report. So over here it says Meta's earnings and why it may be an overreaction. So Meta reported earnings a few days ago, currently down around 15% post earnings, 20+% from the high, and currently in a technical bear market. So the reason for the fall was simple. Meta is overspending. Meta is spending a lot of money on CapEx, and the markets are fearful that all these CapEx investments are not margin accretive for the company. And besides that, hyperscalers have also got their AWS portion, their cloud businesses, but Meta doesn't have that. So the ROI is unclear. That is what the market is fearful of. So if you're to look at the earnings for the company, the earnings were great. This is widely known. The earnings weren't terrible by any means, but the stock is still selling off. It's currently trading at a 20 times of earnings. So my thesis for Meta is simple. So the markets are currently fearful that Meta is spending a lot of money on CapEx. So Meta is on track to spend around 37% of their revenue on CapEx. Microsoft and Google are currently at around 20%. So this begs the question of whether the spending is necessary and justified. So Mark recently said in his Q1 earnings call that a lot of the CapEx is used to fuel their existing business. We're not sure what the percentages are, but he said the word majority, so I would assume it's more than 50%. So one of my theses is that Meta's ROI on the CapEx is actually a lot more profitable than what the markets are feeling today. So if you were to look at the revenue growth profile for the company, for example, Meta is currently growing revenues at 22%. So this clearly shows that there is ROI on the investments. And besides that, if you're to look at, for example, this is the ROIC for all the different companies, Meta's ROIC is actually on par with your tech winners like Google, like Microsoft, and Amazon is the one that is lagging behind all these companies because they're building out their warehouses. So I think the markets are misinterpreting this. I think Meta's ROI has been quite substantial, but of course there are risks to the investment over time. So what Zuck is doing is he's increasing the variability in terms of performance for this company over the next few years by spending all this money. If he spends the money and he allocates it well, this stock could go up a lot more substantially as compared to your other Max 7 companies. But of course, if we have the metaverse event like in 2022, then we could see the stock price falling also, although that is a very different scenario from what is happening today. So besides that, Zuck has also said that the worst case scenario is that they are shifting all this GPU expenditure to their existing business. They've just pre-built it over time. So this is related to a word called fungibility. Basically, the ability to channel their existing investments into AI LLMs into their existing business over time. So this is sort of like a backup option also. If you're to compare this to all your different other hyperscalers, like for example, Amazon, like Google, like Microsoft, all these other companies, they're dependent on external investments. So the company is different from the other hyperscalers. One thing to note, the narrative can change very quickly if Mark Zuckerberg just says that he will manage the expenditure over the next few years. So that is one portion to take note also if you're trying to trade this company. All in all, I view the company as attractively priced today, which is why I've been adding into my Meta position. Last portion, I'll be covering Copart's earnings report. So this is Copart's earnings. They beat the earnings, but they missed on their revenue line. So the stock is down around 2% after the earnings report. And this is their earnings report in summary. So we'll take a look at this. So if we were to look at the income statement itself, revenue grew by around 0.7%. This is the company slowing in terms of growth. The expenses also went down. So this is Copart flexing their operating leverage. So in the last few years, they've been spending a lot of money on capex, on operations. And what the management is doing today is they're managing their cost. This is what they're doing to counter the revenue decline in terms of growth. And net income actually went up by 11.4%. I believe this was because of your income tax expense becoming a lot lesser than what it was last year in terms of percentages. And for Copart, it was an okay report. It wasn't a very good report. So I think for Copart, the main thing that you should be looking out for in terms of the earnings is this line over here, which is the inventories. So inventories is actually a leading indicator in terms of the revenue profile for the company. It's a leading indicator for Copart because your inventory represent how much cars can come into Copart and be sold through their platform. And another thing that I'm actually looking out for Copart is also this line here, which is the cash. Not too sure what the cash is doing and sitting down there. The company is not doing anything with the cash. So this probably means a few things. First of all is they found a better investment rather than buying back their current shares. Second of all is they feel the situation now is still not optimal for them to buy back shares. So the company now is trading at a 25 times of earnings. The last time they bought back shares was also at a similar valuation. So if they're not using the cash, then what that means is they're not seeing the short-term future for Copart as being positive, which means that you should also be a bit cautious in terms of holding Copart shares. So I'm currently now at around 1.8% of my entire portfolio for Copart. I haven't been adding this stock because, yeah, the inventories was a clear leading indicator for the company. And that is why this earnings report wasn't as good as expected. Copart has a few levers that it can pull overseas outside the US. So the international portion of the business is actually growing substantially over time. And that could be a tailwind for Copart. But currently now, the company is facing headwinds in terms of interest rates, in terms of growth as a whole, in terms of your total loss frequency. So one of the largest insurance company, which is Progressive, is shifting its cars towards IAA rather than Copart. And that is why we're seeing declines in terms of inventory for Copart. But for Copart, I think it's a quality compounding machine. It will do fine over time. And currently at around a 25 times earnings, I think the company is around fair value, although it's not a screaming buy at this price. I hope you guys have found this video useful and feel free to check out the Substack. Invest safe.